If, for example, let's say you're never wrong, you're always right, then that just means you're not taking enough risk.
AI. Is it possible that AI could predict market moves, like for individuals?
Family office, they're already rich, right?
Like you are opening portfolio and you see huge minuses.
So your question is, how do you generate at least $1,000, whether it's dividends or capital gains, to be able to live in Bali or Southeast Asia?
Unlock money power.
First of all, thank you so much that you accept my invite.
Very welcome.
Happy to see you here. And can you share with me and the viewers your previous experience, your working experience? What was your occupation? Where you were working? So yeah, please just tell a little bit about yourself.
Sure. So the last place was a large family office in New York. It was called Bessemer Trust. It's primarily, they manage money for their own family, and then they wanted to add on a couple of others, and then it kind of grew from there. But at the end, largely it was one family's money, one of the wealthiest, I guess, in the US, and then they added on because it doesn't take a lot more effort, but you do get the fees anyway, so they took on external money as well. I think they had in total, if I'm not mistaken, close to 300 billion in assets under management, most of which was one family's money. The rest was divided up amongst different clients.
300 billion.
Yes.
Wow, it's in the ownership of one family.
Yes.
Oh my God. And do you have some advices, like if me as a financial analyst, how can I find the job?
How can you find a job as a financial analyst? Probably on career search websites.
So LinkedIn, you just find them.
Or Indeed or something like that. Indeed, I've used Indeed more than LinkedIn experience.
So it was not the contact, you just find the offer in internet.
Yes. I found the listing, I applied, sent in my resume, somebody in HR saw it, it matched the position that they were looking for. Well, I saw the position that they thought that it was a good fit as well, so they called me in. They didn't call me in, it was during COVID, so they called me in, and everything was done virtually on Zoom. So I met via Zoom with several people. They had a first round, a second round, and then they had a third round, which involved a presentation and like a pitch, where the team that I was eventually working with and they were all there, and then some other people were there as well. And they told me to make a mock presentation, like pick a stock, or a bond or something of a company, and then do the analysis and then pitch it to them why they should invest in this company. If they like my process, they don't care so much about what the end result is, whether it's a buy or a sell. They're interested in seeing the thought process and the analysis of how logical it is and how well presented it is. And then they ask questions on how I can defend my thesis, so to speak.
Oh, but I always thought that people focus it on real results. So they focusing on which assets you choose.
Eventually, yes. When you're working on the day-to-day basis, that's what matters. Actually, sometimes that matters. But what matters more than anything else in regular real money asset management, not hedge funds, is the process. Do you have, because things can move in different directions. They can go in your favor, they can go away from you. But in the end, what matters is, especially if things go sideways, is did you have a reasonable and strong basis for recommending? Did it make sense when you recommended it? And did the thought process was logical so that you can defend it if things go sideways? Things go sideways all the time.
Yeah, of course. And you can't predict the market. So, okay. May I ask what were your main responsibilities, like everyday routine? Because like a lot of people imagine financial analysis, like it's people who are in the Wall Street and they always busy, but nobody know what exactly they're doing. And I think it's a little bit romanticized by movies. So are there some boring parts that you don't like, or some parts that excite you in Europe, like when you were working on your occupation?
Well, that changes like over time, but generally from a day-to-day basis, there is like any other job, you are reading a lot. You're keeping up with current events, looking at what's happening in the news, especially as it pertains to, for example, for me was US corporations. Was primarily my focus and my last role. So of the companies that my company has a position in, whether they hold their stocks, what is happening in those companies, and if there's anything in the news. When there's anything in the news that moves the stock price, that moves the bond spreads, and that of course impacts the positions that the company holds. And then that's when the clients will call you and ask you, oh, you put this in my portfolio. Now this happened, let's say some scandal breaks out about management or they post losses that are bigger than expected and like the stock price moves, then clients call you and they want an explanation.
Of course, yeah.
The interesting part can be giving explanations, coming up with creative answers, because that is a big part of day-to-day job. Boring part is but of course the necessary part is the number crunching, the modeling, the coming up with a valuation, which is a combination of art and science, but it is kind of repetitive and it is sort of very Excel based. And then PowerPoint once it goes into the presentation format. But that's all part of like keeping a backup for when things happen. You can present and you can say, okay, this was our basis. So, and then there's a time lag. We think eventually it'll come back, or we don't think it will come back. We think that this is a lost cause and we need to sell it immediately. Take the loss and put our money somewhere else. That's kind of how the data. And then you have lots of meetings where you see what other people are doing and why other analysts or other strategists and why
In the company.
within the company. So part of it is convincing if you have a strong opinion. Okay, I think that these companies will outperform the market and they'll outperform what other people are recommending as well, or by sectors. This sectors I read, it's a part of it is convincing management as to why they should increase risk allocation to your portfolio or to your areas of concentration, or take it away from yours where you have a negative view. You think that things are not going to do so well because either something specific that's happening in the sector, something specific that's happening in politics, or something in the commodity prices. For example, oil prices, if they're going down, no matter how great the company is, that sector is probably not going to perform very well. So there are certain things that are highly correlated with each sector. For example, banking sector is highly correlated to interest rates. If interest rates are very low, then the margins for these banks are going to be low. So they tend to not do well, the stocks of banks, when rates are going down, generally speaking, or if they're down for a long time, or if the economy is going into a recession, people being more delinquent in the loans that they have borrowed, whether they be mortgages or credit cards. And that same thing with oil prices. If oil prices are going down or are very low, then no matter how great a company is, the sector as a whole will not perform as well.
True. Yeah, it's always like that. So when you're an analyst, you need to be confident in uncertain markets, like in certain circumstances.
You have to have a view, yes.
Oh my gosh. But what are the bases why you can feel confident while making decisions? So you first should analyze numbers good and have some technical background. And another one point that you should be prepared to every situation in the market, or to have at least two ways how to diversify portfolio or to cover losses. If my thoughts are right.
Well, you need to have an answer. You need to have a basis for whatever your view or your recommendation is. Things are going to go in many different directions and you will not always be prepared for them, but you need to quickly be nimble and be able to cover your losses or position to take advantage of different scenarios. If you're too exposed to any one particular thing, things go sideways, and generally the losses are going to be higher. So you need to figure out how to quickly get out of it or hedge it or something like that.
Mm-hmm. Okay. May I ask, like, I know that in some companies, they even have special people who are searching for news before the news will come on the market. Like they're tracking a company performance, trying to get some inside information. Is that actually true, or it's only marketing and gossips?
There's a combination. Like one, there's some, like if it's a big news that moves things dramatically, that'll come to market pretty quickly. Generally, for real money asset management, they're so diversified that they don't take big enough positions where they're that interested in finding some insider information. What does happen is some things, news might be there, but it wasn't appreciated or realized by the investor community, or it was downplayed by it, and it might end up being a bigger deal. So if, let's say, you know about it, you think it's going to be a bigger deal than what is being recognized by the market at the moment, then you can position yourself accordingly and then wait for the market to appreciate it in the coming weeks or months. And that's how you take advantage of it.
Okay, so it's possible. Yeah. So
Yes, it does happen all the time.
oh my gosh, that should be excited actually. Like for me as observer. All right.
What also happens many times is you might think that something is a big deal, but it may end up not
but
being
in
a big
fact,
deal.
yeah. But I also heard about the theory of wind castles, and it says that markets couldn't be predicted by numbers, so we can't know for sure the reaction of market participants. Like we can't predict even almost nothing. That should be very hard job. But up to your experience, do you have some formula of the best portfolio for individual investor, I would say?
I can only speak to what I do, and that's the simplest thing, which because I don't want stress related to my own investments. So I would say for everyday simple investments, just pick something that is low fee, diversified ETFs, and hold it long term, which is what I do because I don't want to be involved day to day. I don't want to be doing short term trading, nor do I want the stress related to it. And I don't want to be actively involved. So I monitor it passively, invest long term, be diversified, pick ETFs that are low fees. That's the best advice that I can give from my perspective.
But also there are a lot of different ETFs. So
large enough, like a large ETF where there's enough liquidity so that when there's a need to withdraw money, you can easily do it without too much friction.
And like me personally, I'm expecting for the market crash and the say S&P 500 crash for 7 years in a row already. What do you think about that? If the market right now overheated, or like no, we need to concern another perception of the market, so it's good race till I don't know decades.
Depends what you mean by crash. So there's volatility all the time. There's lots of downswings, upswings, and we've had many, many of them in the last 7 years. So they're always going to be, it went down 50%. Sometimes it goes a number. Well, they say, I don't know what you mean by crash, but we've had many crashes and then they come back. Then we've had corrections. They say 10% or 20%. And then when it's more than that, they call it a crash. We've had both of them, many, many of them over the last 7 years. But if you're doing it for the long term, that it's not really going to your investment horizon in several years, then these things don't really matter that much because it goes up after it goes down after it goes up. I think if you're diversified and a long-term investor into something that is sizable enough where their friction cost of getting in and out is not that much, it's always going to be high in a downturn. So you don't want to be selling when there is a downturn. You want to be selling in an upswing and hopefully putting money in when there's a crash, when there's a correction, when there's a downswing. Then over time, it'll work out in your favor.
But if you already exit from the deal on the very high, what are your next steps? You will consider other niches, or you will consider other instruments which are in top priority, or how they choosing the instruments, even we would say among ETFs. What are bases that you rely on while choosing, like picking some ETF, for example, it's tech sector, yeah? So tech sector has a good perspective in the future, alternative energy, and I don't know, AI, computer science. That's all for future, but we also need something stable, like water supply, gas, and all that stuff. So how you choose ETFs for your personal portfolio?
So I try to avoid like sector specific exposure at any concentrated levels. I basically just take something that is super diversified, like S&P 500. Yeah, I just invest in that, so that in which there is oil and gas, there is utilities, there is tech, there is consumer discretionary, non-discretionary, every single sector that you can think of is part of a diversified, let's say S&P 500 ETF. So you're not overexposed to any particular sector, so to speak. Now, there's always going to be heavier concentrations. For example, at the moment, I believe it's tech because the valuations have been high for a long time. That used to be the case with banking decades ago. Then before that, it was energy. That's always going to be the case. So I'm okay with that. But there are also ETFs where they're not market value weighted. They're weighted maybe equally or something like that. But I haven't done that. I just pick the basic S&P 500 ETF. But I know people that do. For example, they don't want to be overexposed to something. If like one sector is gotten over, like in their opinion, then they prefer to have an equal amount of exposure to every sector, where it's like continuous rebalancing is done. But then you're talking about an actively managed ETF. Then the fees are going to be higher. I prefer to not pay high fees and take the market value exposure if there is, so to speak. I'm okay with that.
I got it. But what do you think about the income, possible income? So you have a portfolio which brings you some passive income, and you can afford living in Bali using only passive income. My friends of mine, he told me like it's almost impossible. So can you share about how much percentage you can receive from your portfolio, and what is the minimum which provides you with at least 1,000 per month of passive income, and you can relax, like you have no high risk? What sum should you collect in order to live this dream life?
So there's two ways. There is income that can come to you through dividends or interest income or something like that, preferred stock, which is still dividends, which is at least from a US perspective, and probably many other ones as well. So the most of the large companies in the US, they don't really pay a lot of dividends. But from a tax purposes, it doesn't matter whether it comes to you in the form of a dividend or it's just capital gains, and you sell whatever amount you need in, let's say, every 3 months, 6 months, every month, as long as you hold it for a year, it's long term. So from a tax perspective, it's 15%. So whether you sell it and then you take capital gains, or the company pays you a dividend, it's the same thing. There's no difference. So your question is, how do you generate at least $1,000, whether it's dividends or capital gains, to be able to live in Bali or Southeast Asia? So the numbers that I have heard that I think make sense is if your overall size of the portfolio is big enough where that 4% of that on an annual basis, 4% per year, let's say it's dividend or capital gains, amounts to 1,000 or more, which is livable here, parts of it anyway, then that is what you can do sustainably for a long period of time. And what that means is that amount will grow faster than what you're taking out, so that you can do it for a whole lifetime.
Okay, but what we should do in case our portfolio in the downside, like when
it should matter. Just take what let's say it's X, right? Just whatever it is at the moment. So 4% of that number, right? Let's say you take 4% now, and then in a downturn, it might be, when you take it out, it will feel like a lot more than 4% because it went down in value. And that's okay, because the next year it might go up, or the year after it might go up. So as long as you don't take out more than roughly 4%, it can be 3, it can be 5. But on average, if it's 4% at any given point in time, if you don't take out more, on average, let's say 3-year average, 5-year average, something like that, you can calculate it, 4% or less, over time, you will be fine.
Okay, that's very smart. No, not a lot of people can handle that. All right. I just heard also, I made a note for myself about new ETFs.
Excuse me?
I made one moment. I heard about new ETF like ESG ETFs, what are environmental, social, and governance ETFs. As far as I go, they're focused on some, let's say, charity and trends, social trends, and also environmental support. So they have very strong values inside of them. Do you think, and as far as I know, a lot of Zen population, they prefer these ETFs for holding. Does that make sense, or it's one more, how to say, hype from your opinion?
It's hard to say. I think you have to either look at the individual companies yourself. I don't like the idea of simply relying on like a ETF that's claiming to be ESG and outsourcing investment morality. I don't know, whatever you want to call it, whatever you want to call it. I have never done that. I've heard a lot about it and I know people do it, but if you really want to do it, then maybe do it yourself. Figure out, okay, what are these companies claiming to be, or what this ETF is saying about the companies that they do, and are they actually doing it? And if that aligns with your values, maybe that's a great idea for those people. From my personal perspective, I have never invested that way. There were, when I was working for a couple of companies ago, we had specific portfolios mandates where we're like, okay, we want to be ESG compliant. Primarily, I think they were European clients, because ESG is way more attractive to European clients than it ever became to US clients. And then there was like a big scandal where it turned out that, they were writing a lot of checks they couldn't cash and saying all these things that they're doing, but they weren't doing it. And when everybody was issuing ESG specific debt, and they were even like the biggest polluters in the world, they would specifically issue like ESG bonds and say, okay, this part of our portfolio is ESG, but the rest of the company is not. So it's a very loose definition of what it means. And there's all different types of, I think, in companies and sectors that claim to be, okay, we're ETF, we're ESG for this reason, we're ESG for this reason, to the point where everybody became in one shape or form ESG. So it kind of lost a lot of meaning. But it did catch a lot of hype. It attracted a lot of money for that reason, because everybody wanted to feel good about themselves, that, oh, we're creating some good in the world. So I think, like, to do it right, you probably need to do it yourself and then figure out and then monitor it continuously, because one decision can take it from ESG compliant to non-ESG compliant. And then there are scores as to, like, it's not black and white. It's a range of like, okay, this company in this sector is higher ESG score, lower ESG score. So it's not that one company might be ESG, one might not be. It's like there's a large scale where they're ranked based on who's higher and lower. So then it's a function of comfort level. Okay, I like a score of, let's say if it's out of 10, 7 or above or something like that.
So just experiments.
Yeah, I mean, I think the mandates, from what I remember, the certain portfolios where they wanted, one mandate specifically didn't want any exposure to gun manufacturers. And that was their way of ESG. Then there was one that didn't want like oil companies, specifically in exploration and production, because they're digging holes in the ground and that's not good for the environment. So like it was different ESG mandates had different requirements as to what they considered their version of ESG, so to speak. There's no one like ESG and non-ESG. It's very like sort of sliding, flexible scale, subjective, so to speak.
But they analyzed by some government or like some tech or some commissions.
Well, there's three parts of, so ESG stands for environmental, social, and governance. So there are companies, for example, that could be great with the environment and great with the social aspect, but then they don't pass the governance aspect. For example, if the board doesn't have like a certain level of independence, if too many people from management are on the board, then it fails like that part of ESG, like the G part of it. Mm-hmm. So nothing to do with the environment. They're great. Nothing to do with social aspect of things. It's just like their structure of the organization wasn't in line with certain ESG requirements. On the other hand, you could have a company that's very well run, makes a lot of money, and has all the neutrality that it needs on the board, but it could be in a sector like oil exploration and production where it fails that piece of it. So it's like There are people now, I think, like most large companies have specific ESG analysts. Their sole job is to look at it's to just see, okay, are the portfolios in compliant with the ESG requirements of the clients? Because each client may have different ESG requirements for their portfolios.
I got it. All right. By the way, about the new technology, new trends, what do you think about hype topic, AI? Is it possible that AI could predict market growth, like for individuals? Because I heard a lot about the simple people, about that they're consulting with the AI, like ChatGPT or other LLM system. And I do know that a lot of companies also, like at least hedge funds, using bots and using AI for trading. What about the family office? Is it possible to implement AI in process?
Yeah, certainly possible, I would say. And to an extent, anyone can use it. For example, you can go on any ChatGPT or any AI and ask them, because they have access to publicly available, AI has access to publicly available financial data, and it has access to the stock trends and charts. So you can ask it to do trend analysis, and you can ask it to do financial analysis and compare it to other companies in a sector, and then valuation of its stock versus other ones. So is it overvalued, undervalued? So from that perspective, yes, it can do a lot of things that a human does and used to do for decades, and it can do it a lot faster. So it can tell you an opinion on, okay, based on these markers, okay, trend analysis, where how it's traditionally done, and where it's traditionally traded versus where it's trading now on a 3-month, 6-month, 10-year, whatever basis. Is it overvalued or undervalued? So absolutely, it can do that. It can do that much quicker than a human can.
Yeah, but I also heard that in my case, sometimes when I use ChatGPT for marketing, which I'm doing for a long time, I see some mistakes in formulation, or I see that it misses a little bit real experience, or sometimes he would like to please me. So he's telling what I want to hear. He guessed that I want to hear, or something that's related to the context. But I do understand that the facts are not that true. So have you tried AI for like some portfolio tips or something? What is your experience?
I haven't. I've just kind of played around. I haven't made any taken actions based on what it tells me, but I did play around with it once to see how it presents and how it analyzes stuff. And it does it very similar to like what I would see in a professional report published by a Wall Street analyst. It can like take the same data points, make the same charts, come up with a similar text that looks very pretty. So anybody can be wrong. And of course, like AI can be wrong as well, because when you're predicting the future, nobody can get it 100% right, including any machine or a human. If they do, it's probably going to be just a coincidence.
I think, the most important thing is after you already, I would say, create a portfolio based on AI advices, you should go to AI one more time when the market will collapse or when you don't know what to do. Because I always say, like, in investments, when you're purchasing something, you need to keep in mind, okay, how I will act in case, what are my investment goals? And if market will change, the market conditions will change. What would I do? And when you do analyze so if you're just relying on AI, you need to go to be sure that you can go back to it and just to ask him, show you the perspective and show you where to reinvest or close position or hold position, like all this stuff. So I fully agree with you. Oh, that's cool. But may I ask also you what we are seeing in the movie about the family offices, about the hedge funds, about the mutual funds? From your perspective, do they show a lot of truth, or it's always like a little bit fairy tales, like it's...
Well, the job of a movie is to be dramatic, and they can be boring. Otherwise, nobody would pay to watch it. It's a product.
Yeah, true.
So if they started showing the day-to-day mundane part of any job, whether it's Wall Street or a law firm or a detective or police, or because most jobs where people work for like decades of their lives, it cannot be as exciting as they show it in movies because it's too much action and people, their mortality rates will be really high for different reasons. So of course they have to show like what is more juicy, what is fun to watch, what is exciting. So they reduce it and they show the moments that are the most dramatic. And those moments do exist, but they don't exist in the frequency that they show you because a movie is an hour and a half long. A career in a job is decades long.
Yeah.
So when you're trying to reduce decades into a few hours, you have to pick the moments that are the most exciting or that are the most dramatic.
Yeah, true. But have you ever seen like movies like a Wolves from Wall Street, Billions?
Sure,
You heard
sure.
about that?
That's a show.
Or about the 2008 crash, about real estate crash. So how many truths they show from your perspective from real Wall Street? Like at least might be 10% or 15% or
Well, like I said, like isolated events happen at different parts, different companies, right? And they have to take the most dramatic events and the most dialogues and whatever they can to get the most audience in a way that at least feels like it potentially could be realistic and then show it to you so that you watch it and you buy the movie ticket or you go to Netflix or Amazon Prime. I think that's where Billions is. It's a great show, but all of those things probably won't happen to the same person. What you do is to make a good show is you take all the dramatic and crazy, attractive things that an audience would want to watch and put it into the same show with the same person.
Mhm.
And so maybe, okay, one thing happened to one hedge fund manager, the other happened to somebody else in a span of like 30 years or more, but they have to, of course, make it happen in the life of one person's professional career within a couple of hours. So yeah, in an isolated way, they could all be true, but it's unlikely that it would happen to like one person in like, I guess a season is just a few months long, in just a few months.
But I think the last question I would like to ask, while you analyzing the instruments for portfolio, let's say it's ETF as well, what are main criteria you would recommend to watch at first, like its price earning ratio or which financial indicators you should consider before purchasing something, or it's very individual thing, it's all depends on your strategy.
It certainly all depends on your strategy, but the one that I do for my personal portfolio, as I mentioned, is long term. So I'm not trying to time the market in any particular way. What I did was over a long period of many years, I just kept putting money in without worrying about timing. And in the long term, it tends to appreciate, it goes up, and then I take out what I need to live using that 4% rule, and the rest just stays there and grows over the long term. That's the simplest way to do it. Now, when I was working professionally and managing portfolios, then it's different because they want to see, then it's about buying and selling lower, potentially stocks that are likely to underperform and trying to pick the ones that are going to outperform. That's more active management for individual investors that are not necessarily in this field. Like that's not their job. They're not day trading. That's long-term simple investment that I talked. That's the best way to go. It's in terms of indicators. Yeah, for large companies, for ETFs, like there's the indicators that I would recommend are very simple. They're like large diversified companies that are so large cap stocks that are in an ETF that is large. The A of the ETF is very big, so there's enough liquidity so that we can get in and out quickly, and the fees are low. Those are the indicators that I pick when I'm picking an ETF. Yeah. Away from that, like there's lots of things you can do on a fundamental analysis, then there's technical analysis, then there's charting. And even a combination of all those could potentially produce a decent result. But statistically and historically, most asset managers or hedge funds, there are some years where they outperform the market and they charge a lot of fees. But over the long term, most of them actually underperform on an after fee basis. So the best strategy is long-term buy and hold, and you take what you need and the rest just stays there and grows so that You don't have the tax issue to deal with, and you also don't have you're not trying to time the market because timing, it's very difficult for most people.
Yeah, true. Holding the emotions as well, controlling.
And then there's the mental health aspect on top of that, because then you're so invested mentally that every day you're watching your portfolio, and then it kind of, your quality of life might deteriorate as a result. So for individual investors, the best strategy is, I would just repeat what I said before: buy and hold, long-term, diversified ETF with low fees.
Yeah, true. Oh, that's cool. Okay. So can I also ask about the numbers? If you are talking about that it's not possible to predict the market, do we have any sense in fundamental analysis? Like, and also you are like analyzing indicators and using numbers. If we can't predict the people behavior on the market or even huge corporation behavior on the market, does it make sense, or it's like, formal thing in finance?
They do matter. Fundamentals matter, but what would happen is when you hold let's say a large ETF, generally a company, if the fundamentals are not worthy, if they're like really bad, that is, then the company would never make it to the S&P 500. And one or two, even if they make it, they won't stay there for too long if they have losses for a certain period of time, because there's certain requirements, very specific requirements for a stock to be part of an S&P 500 or part of any large cap index across the world, whether it's Europe, US, or what have you. Because it falls out of the index when it doesn't have consistent profitability for a certain number of years, or it never makes it to begin with. So yeah, if you're investing in those companies, you wouldn't have to worry about that. The index manager itself would worry about that. And is done, like, things are always coming out and going in, like it's a dynamic process. To be part of any index, you need certain requirements.
So it makes sense for people who are working in this field, but for simple investor, like everyday, like normal people who are not working with the finance. Does that make sense for them
to do themselves? The fundamental.
Yeah, to learn.
It would make sense to look. Yeah, I mean, the basics is always a good idea to know and learn, and you can just look at them and analyze them. You don't need to like build models for these large companies, because plenty of models already exist that you can just look at. What would make sense is to see, okay, well, companies have consistent profitability. Do they have any outside exposure to like anything that's happening in the world? For example, like a large company, everything could be fine, and they could have one company could have an outsized exposure to some place that where like a giant war breaks out, or like nationalization of like certain industries could happen. And sometimes what these large companies do, though, they manage their exposure. They're like, okay, we don't want to be overly exposed to any particular unstable region of the world or something like that, or a sector of the market or something like that. So you can look at it, but if you're an ETF investor, there is very little you'll be able to do about it. Because if you own a diversified ETF, then the whole point of it is for it to be diversified enough where you can only buy and sell the ETF itself. You cannot sell or buy the individual components that are like penny stocks within the ETF. So it'd be good to be aware of it. But let's say if you own like an AI ETF, for example, right, and it's overly exposed to one company, something crazy could happen within that one company, and that whole ETF valuation could go down. And that happens frequently. Or if you own an oil and gas ETF or something like that, like it's always good to manage what is the individual company weighting within the ETF. So some of these ETFs have, I don't know, up to 20% or more in one company. So you really want to know what's happening. If you own such ETF, you want to know what's happening with that company.
Okay, so that's definitely makes sense. All right. Oh, okay. Thank you so much for today. Thank you for sharing your knowledge. It's really valuable, even for me. So I can summarize that if you're an investor, it's better to control your emotions in drawdowns and upsides. Like in trading, I think we are also doing the same. We are controlling risk, but in investment, you should have enough self-control not to escape from the market on the very drawdown for low prices and sell on the very high period, not to be that greedy to hold it till the correction will start.
There's a famous saying, I believe is by JP Morgan, if I'm not mistaken, which relates to your question, which is you sell at the sound of trumpets and you buy at the sound of cannons.
Yeah, so that is also working for long-term investors and even for those who holding conservative portfolio.
That's correct.
I'm just very impressed by you because, like, for me, controlling these emotions, it's like very high professional, especially when you're handling someone's money. It's caused additional pressure, right? Right? Or for you, it doesn't matter. Like you have professional deformation, so you don't feel the pressure.
No, you definitely feel the pressure for sure, because anytime something moves in a dramatic way, you get pulled into a meeting and then you have to explain what was the basis for being in this position in the first place. And that's why you need the proper analysis and documentation of things that you did so that you can say, okay, when we made the decision, it was based on these reasons, and these reasons made sense with the information that we had at the time. There was no other information that we missed or that we overlooked, and that caused this big blow up to happen, because that can happen to anybody, and it's never going to be that you're alone. There's always like many different other investors that have the same view, and you are always taking a bet. And if, for example, let's say you're never wrong, you're always right, then that just means you're not taking enough risk. So you have to, you want to be right more times than you're wrong. That's what you aim for. You don't aim to be 100% right all the time, because that just means you're not taking enough risk.
Oh, amazing. Okay, a lot of people thinking that you're predicting the market, but in fact, what family offices do, they just making decisions.
Family office, they're already rich, right? They're not trying to get rich. They're just trying to maintain and grow their portfolio over time so that the generations to come can live off of it. Family office, like an endowment or a foundation or a trust. So they're already rich, right? They're not trying to get rich. They're just trying to maintain and let's say 5% or something per year, so that the generations to come can live off of above their spending needs. And of course, beat inflation and all that, and beat the market and all that stuff, of course.
And for simple investors, I would say retail investors, it's also important. I mean, in these terms.
Yeah, as a retail investor, you definitely want to beat inflation so that you're not getting poorer as time goes on. And you don't have to necessarily beat the market. You just want to be able to do as good as the market, preferably whatever your benchmark for the market is. And you want to be able to support your living expenses over time. If you are living off of your investments, if you are the saving accumulation phase of your journey, then you just want to grow it, and your horizon is long term. So you don't want massive losses. You just want to be, as long as you're performing as well as the market over time, which you should be, then that's all you really want.
So we can say that financial markets, it's like a beautiful trips, and your road depends on your goals.
And your risk tolerance and all that stuff as well. Yeah, your risk tolerance is a big piece of it. For some people, they take your risk appetite, right? So some people, they can take more risk, they can handle the volatility. Some people don't want to see that much movement in their portfolios. So there are surveys you can take online to gauge, okay, what is your risk tolerance as a person? And then you can help design a portfolio based on your answers to the questions the surveys ask you. How much of your allocation should be in what kind of stocks, and how much of it should be in, let's say, bonds or savings account or something like that.
But from your perspective, what is the best action after you see drawdown?
After that?
After you see your first drawdown. Or
drawdown.
Drawdown, yeah. Like drawdown of portfolio. Like you are opening portfolio and you see huge minuses, and you're like in panic, and you don't sure for how long it will, like,
you never know how long it will take to come back. And these minuses or negative numbers, I see them all the time. I do nothing, because sometimes I see big pluses, sometimes I see big minuses. That's all part of the process, part of the journey. And as long as you don't need the money right away, then that doesn't really matter. Whether it's pluses or minuses. Yeah, I mean, okay, you feel good when you see pluses, or like, oh, I see minuses. You have like, oh, okay, I wish it was a plus, but it's just temporary. The pluses are when you see the big ones, they can be temporary, and then the minuses are temporary as well. So you just move on. It's if there's, you can check the news to see if there's anything unusual happening, but if it's just out of, and even if there is like some sort of correction or some massive news that came out, you know that even that's going to be temporary as long as the portfolio is diversified.
That's wise approach. Like that, all people who are involved in markets should learn like emotional control. Yeah, that's it.
Yeah.
Yes, thank you so much. I was diving a little bit in the Wall Street with you today.
You're very
I'm
welcome.
speaking from my heart. Thank you.
You're very welcome.
And you look so confident.
Thank you.
I
You
do. Thank you so much. That's amazing.
Take it off.
I can't even imagine how much responsibility you have. Like when you handle someone's money,